Good morning. Welcome to ActivTrade News. This week we're going to be discussing will stocks march on in the wake of the momentous Brexit vote. Then we're going to be looking at why the government bond yields have fallen to fresh and record lows, led by the UK gilts. And then finally we're going to be looking at Brexit in the city and whether or not Europe is planning a banking heist. So Mark Carney, who's really the hero of the hour, I think, the one person probably still running the country with any vestige of confidence perhaps from the British public. He said on Thursday when he made that emergency announcement that the economic outlook had deteriorated and some monetary, I'm quoting him now, some monetary policy easing would probably be needed over the summer. So my first question really is, to what extent do you think the uncertain outlook for the global economy will begin to stay the Fed's hand near term? And do you doubt that the Fed will now tighten before December?
I think a lot of this feeds into from the Brexit. The Fed met before Brexit, we're still talking about a rate hike. Mr. Dudley overnight talking about the Fed can be patient in the new environment. The Fed now seems unlikely to hike this year because it doesn't need to. The dollar is essentially doing the hiking for it, in the sense of the fall in sterling against the dollar, the fall in the euro against the dollar, the rise of the dollar against the Chinese yuan. In fact, you could argue to some extent the United States might start to import disinflation from China, which is obviously going to weigh on inflation expectations. But drawing all the threads together to what you mentioned in your introduction, Brexit has kicked off a process where central banks around the world are essentially trying to avert the Lehman moment. It is a Bear Stearns event, but by flooding the market with capital, you're trying to calm investors' nerves. Net result is, obviously, the Bank of England's been at the forefront of this. The Bank of England easing the capital buffers for the banks, making warm and comforting noises about the provision of liquidity. That has weighed on the pound. I believe yesterday Cluedo decided they were going to kill off one of their characters. Well, they could replace it with Mark Carney because he's basically just killed the pound in the courtroom with a hammer by doing what he's doing. The Bank of England couldn't save everything, and the pound is going to be allowed to take the strain. So we pushed down to 128 this morning against the dollar, bounced back up again, but you're only buying the sterling, if you are buying it at all, for a quick rally, and then you're out again. Because the psychology is you sell the rally, because that's the message basically Mr. Carney gave you. He didn't show any concern. That means the FTSE 100 actually catches a bid, because so many of those companies earn their money in dollars.
Overseas.
It's a different case for the FTSE 250, where you've got a lot of companies that are within the United Kingdom, and they are bearing the brunt of the post-Brexit environment. But there again, when you have 4 months of Project Fear, and then the country still votes to leave, you have to assume there's going to be some fallout from that. Net effect is investors pile into government bonds as a safe haven. UK gilts prices coming down. I think Swiss bonds now are negative now out to 50 years, something crazy. Japanese rates are coming down, dollar rates are coming down. I think the 10 years hit 134 overnight. That is an all-time low. That in turn puts upward pressure on United States equities, because if there's one thing I am certain about is people didn't expect a leave vote. Brexit wasn't factored in.
Not in the game plan.
And therefore, most people, even in the United States, were not long of US equities because they were looking for the rate hike. Now they're looking for the rates to stay where they are, and 134 10 years. You end up back in the dollar, and incidentally, even if you come in as an overseas investor and buy the FTSE 100, or even the 250 because you think it might be cheap, you've got to do the currency hedge, because if you think the Bank of England is going to create the conditions where equity markets actually calm down and start to move up, those same conditions will continue to weigh on the pound. So you don't want to lose on the currency what you might make on equities. And it's the same for the Eurozone. The same thing there when the ECB comes out and does its stuff, because the ECB has now got big problems with Italy. And the Prime Minister Renzi, the banking system is ticking away. And no one wants to be in the room when that one goes off. And Mr. Renzi has been quite clever, opportunistically using Brexit in an attempt to push through his own agenda for Italy.
Yeah.
But the net result is the euro can't catch a bid, because essentially, if we're going down the tubes, then the Eurozone's not going to be far behind us, because Britain runs Germany's second largest trade surplus in the world. Not just in Europe, in the world. It's with Great Britain. So if we're not buying their stuff, they're not earning the money. And if they're not earning the money, they can't write the checks to support the rest of the Eurozone.
And are you expecting that the UK leave vote will weigh on European growth now? And will it imply that global yields will be low for even longer?
I think we are in a situation where a lot of us, including myself, has thought that the global bond market rally of the last 20, 30 years was coming to an end. We were going to go back into more normality. Brexit changes that. But Brexit has really only put the focus, essentially, on what's happening in wider Eurozone. Europe never fixed itself. The Greek can has been perpetually kicked down the road.
Sure.
And now all of a sudden you have a situation where the contributor nation, United Kingdom, wants to leave, and the European Union...
Just 20% of its budget.
Exactly. And the European Union seems quite happy to deal with this with some undue haste, having spent months and years trying to sort out Greece, which is financially a basket case. There's a contrast there to be had.
And what are your thoughts on whether, or if you expect the UK to fall into recession now in the second half of 2016 or early 2017? Do you think that's now an inevitability?
I think it is an inevitability, but it shouldn't be a surprise given the enormity of what we've done, and the idea that Great Britain picks up on exports because of the drop in the pound. Yes, it happens, but it doesn't happen overnight.
Coming on to the second issue now, why have the government bond yields fallen to fresh record lows? Initially, I just wanted to ask whether you believe that this is one of those key moments in global fixed income.
Yes, I think it is. I think because the world's changed. The super cycle, which we thought perhaps was coming to end, certainly Janet Yellen was looking to normalise it, and it's one of the reasons why there was so much demand for the dollar, because the United States was the first person the biggest economy to start to tighten. But that's on hold now. And it seems to me that the Federal Reserve anyway has been looking for an excuse to kind of backpedal a little bit.
Yeah.
Brexit's a perfect excuse. But it doesn't mean to say that the demand for the dollar is going to go away, because in this kind of global environment, investors are nervous. That's why they're buying gold. That's why Chinese retail has been buying silver like nobody's business over the last couple of days. And that's why people want the US dollar and other currencies such as the Japanese yen, which to some degree is seen as a safe haven.
Flight to safety.
It's a flight to safety. That's not going to change anytime soon, because we don't know what's going on. The Europeans don't know what's going on, and neither do the Americans now. So as an investor, you just basically want to look after your capital. And the issue becomes not the return on your capital, it becomes the return of your capital. And that means the US dollar.
And do you think we're at a tipping point in that we are very close to another large leg down in US Treasury yields?
We hit the 134, all-time lows. It's just a number. It's just
but it's a psychological
number. It's a cycle. But previously it was 152. That was the previous, and then we banged back up to 2 and banged down. We broke through 152, going down to 134. The bottom line is, if I want my money back,
you want to be able to
Uncle Sam's going to pay me, right? I really don't care about the yield at the moment. I just want to put my money safe.
Thank you very much for watching ActivTrades News, and please join us next week.